Who says you can't turn a small investment into a hefty portfolio? Take a close look at stocks like Nike, Starbucks, and Zoetis, each presenting a unique opportunity to buy into quality companies at a discount with promising growth prospects. For instance, Nike has turned a modest investment into a fortune over the decades, and even now, amidst a rough patch, analysts foresee a rebound. On the other hand, Starbucks, a familiar name in coffee, is tweaking its global strategy to maintain its competitive edge and ensure continued growth. But the question is, will these stocks fuel the next wave of your investment success? Stay tuned to find out why diving into these discounted dividend stocks could be your smartest financial move this year. 1. Nike, NKE. Since its IPO in 1980, Nike has been nothing short of a financial marathon runner. Think about this. A modest $1,000 investment back then would now be worth a whopping $800,000. That's an eye-popping return of 80,000%. But here's the twist in the tale. Recently, Nike's been stumbling a bit. This year, the stock has taken a nearly 18% hit, landing it among the top 5 underperformers in the Dow Jones. And it wasn't just this year. 2023 saw Nike among the biggest losers, even as the market was picking up pace overall. Just last month, the stock price dipped to $95.11 after hours, marking its lowest point since last October. Despite these hurdles, there's glimpses of hope on the horizon. During the latest earnings call, Nike's CFO, Matt Friend, painted the next fiscal year as a year of transition. They're bracing for a bit of a dip in the first half, but expect to bounce back with growth in the latter part. Analysts are on board, predicting a rise of 2.6% in revenue and a 6.5% boost in earnings per share for fiscal 2025. Now, let's peel back the layers and explore what catapults a company like Nike to heights of global recognition and financial success. When you think of Nike, you think big, right? Over the last 40 years, Nike's formula has been remarkably straightforward. Increase sales and earnings and watch the stock soar. Just last year, they clocked in revenues of $51 billion and net income of $5 billion. Numbers that are light years ahead of what they were back in the 1980s. So, what's the secret sauce? Let's break it down into 3 key ingredients that have defined Nike's journey to becoming a powerhouse. First, the power of branding. Nike isn't just a brand, it's a beacon in the world of sports apparel, rivaling behemoths like Apple and Coca-Cola. This iconic status doesn't just happen. It's crafted through decades of strategic marketing and storytelling that resonates deeply with consumers. The swoosh logo. It's a symbol of excellence and aspiration. Supported by a galaxy of stars from Michael Jordan to LeBron James, whose endorsements keep the brand in perpetual spotlight. And then we have innovation and adaptation. Nike never rests on its laurels. With a mantra of consistent innovation, particularly in digital strategy under the Consumer Direct Acceleration Plan, Nike stays ahead by continuously rolling out new, appealing collections and utilizing tech to connect with consumers worldwide. It's not just about making shoes, it's about setting trends. And lastly, global dominance. Nike's reach is truly global. They've built a formidable presence in places like China, where Western brands often struggle to gain a foothold. With over half of its revenue coming from international markets, Nike's worldwide appeal is significant and essential to its success. While this fiscal year has been a bit of a hurdle for Nike, there's good news on the horizon. Sales and profits growth are expected to pick up speeds in fiscal year 2025. Why the optimism? Well, for starters, Nike has made significant cuts to its inventory, which is a smart move to bolster the pricing environment. But here's the real kicker. CEO John Donohue has announced what he's calling the start of a multi-year product innovation cycle. This isn't just about a few new shoe designs. We're talking about launching brand new franchises, concepts, and platforms that are set to take Nike's entire portfolio to the next level. Considering the current lukewarm valuation and the anticipated rebound in growth next fiscal year, Nike looks like a solid buy at today's prices. If you're thinking long-term, these shares are poised for a comeback over the next few years. 2. Starbucks, SBUX. Considering a smart investment with your $100? Look no further than Starbucks, currently priced near its 52-week low at $86 per share, presenting a prime buying opportunity. This renowned coffee giant has rewarded long-term investors with significant gains over the last 30 years, though recent performance has been more subdued. Currently, Starbucks is navigating some challenges. Its vast network of over 6,800 locations in China, its second largest market, is feeling the pinch from the country's economic slowdown. The situation is compounded by geopolitical tensions affecting its operations in the Middle East and stiff competition at home from rivals like Dunkin', Dutch Boys, and McDonald's. Despite these hurdles, Starbucks continues to expand its financial footprint, boasting an 8% increase in revenue to a record $9.4 billion in the last quarter, with comparable sales up 5% year over year and a 20% rise in adjusted earnings per share. Analysts remain bullish, projecting a robust 15% annual profit growth over the next 5 years. Starbucks also offers an attractive dividend, currently yielding 2.6% and growing at over 8% annually for the past 13 years. So why invest in Starbucks now? Beyond just the numbers, Starbucks' enduring appeal is rooted in its strong brand recognition. With a legacy spanning over 50 years in the cutthroat restaurant sector, Starbucks has built a competitive moat that allows it to charge premium prices and maintain a significant edge over its peers. This advantage is bolstered by the company's successful digital strategies, including one of corporate America's most effective loyalty programs, which boasts 34 million active US members. This program encourages repeat business and creates a potent engagement channel, further solidifying Starbucks' market position. For those looking to invest in a company with a proven track record and strong future growth potential, Starbucks is a compelling choice at this discounted price. Moreover, let's talk about growth and the sheer scale of Starbucks. With an impressive 38,587 locations lighting up the globe and a cool $34 billion in revenue for fiscal 2023, you might think, what more can they do? Well, hold onto your coffee cups because Starbucks is far from hitting a plateau. That's where the ambitious triple-shot reinvention plan. The big idea? Booster their global presence to a whopping 55,000 stores by the end of this decade. And yes, a huge chunk of this growth is expected to sprout in China. But let's not overlook the home front. Over in the US, where the coffee culture is a staple, they're planning to sprinkle more than 3,000 new stores across the landscape. Now, here's where it gets really interesting. Starbucks is rethinking its classic cafe model. The future is all about smaller, digital-first outlets tailored for speed and convenience. It seems the days of lounging in a Starbucks for hours may be shifting, as today's coffee lovers is all about grab and go. This strategic pivot isn't just exciting, it's downright smart. Starbucks is gearing up to meet and exceed customer expectations in the most convenient way possible. And the numbers speak volumes about their confidence. With projected annual increase of 10% in revenue and 15% in earnings per share, it's a bright future ahead for this coffee giant. So, for anyone questioning the growth potential of Starbucks, it looks like there's plenty of fresh grounds worth exploring. Starbucks isn't just a place to get your daily caffeine fix. It's also a solid pick for your investment portfolio. Why? Well, let's talk numbers. You can now grab Starbucks shares at a forward price to earnings ratio of 21. That's pretty much in sync with the broader S&P 500. Cast your mind back slightly over 2 years to the start of 2022, and you'd have seen Starbucks trading at a forward P/E of over 40. Yep, investor excitement was through the roof back then. While that hype has mellowed a bit, don't get it twisted, Starbucks is still raking in the profits. And there's more good news for potential investors. Starbucks is dishing out a dividend yield of 2.6%, just as we've mentioned, and it's been upping that dividend for 13 consecutive years. Consistency is key, right? Plus, they're really flexing their financial muscle with share repurchases, having spent a whopping $1.3 billion in just the first quarter of 2024. All these savvy financial moves are designed to enhance returns for shareholders, making now a brilliant time to consider adding some Starbucks stock to your collection. Why not make your portfolio a little richer while you sip on your next latte? 3. Zoetis, ZTS. Now this is a real titan in the dividend stock world that's recently been spotted at $149.77 a share. Notice that tiny 0.14% dip? It could be that the perfect moment to jump on what is usually a super steady investment. Born in 1952 and based out of New Jersey, Zoetis isn't just big. They're the largest global manufacturer of animal medicines and vaccines, covering everything from your backyard pets to livestock around the world. And ever since they spun off from Pfizer in 2013, they've been totally zeroed in on animal health, launching innovations that have pushed the whole industry forward. But Zoetis doesn't just stop at drugs. They're all in with diagnostic products, genetic tests, bio-devices, and services that make them a one-stop shop for animal health needs. Their R&D team is always busy whipping up new vaccines and treatments that tackle everything from the common cold to more bizarre diseases out there, all backed by some sharp strategic partnerships. What's really cool about Zoetis is their knack for staying robust even when other big players like tech giant Nvidia get shaken up. This makes Zoetis a solid pick to diversify your portfolio. Financially, they're as stable as they come, with small ups and downs that paint a picture of consistent growth over the long haul. The analysts are all over this one too, throwing out price targets between $195 and $260 based on their never-ending stream of healthcare innovations. And with a reach that spans over 100 countries, Zoetis taps into the booming market of pet ownership and livestock producers, boosting their revenues and buffering against market swings anywhere in the world. Plus, they're really into doing things sustainably and ethically, which not only minimalizes their environmental footprint, but also pumps up community health standards, especially in those rural areas that depend heavily on agriculture. With all this going for them, it's clear why Zoetis is a standout investment. As we keep zooming in on health, including how we take care of our animals, Zoetis is perfectly positioned to lead the charge. They're not just about growth, they're about stable, smart expansion in a sector that's only going to get bigger. And that wraps up our deep dive into 3 of the market's most promising yet undervalued dividend stocks today. So, what are your thoughts? Which stocks do you think are the best candidate for your portfolio, and why? Drop your opinions in the comments below. Don't forget to leave a like, subscribe, and turn on that notification bell.